Yeah, thanks so much for being here today. Really appreciate it. So, when I think about your style of investing, along with Warren Buffett, it's very aligned to value investing. And when we think of value funds, those overweight in financials, utilities, industrials, they've underperformed growth funds since the '08 crisis. Growth has led the way of outperformance, particularly in tech. When we think of the S&P 500, over 25% of the weight is in the top five tech companies. We have NVIDIA, Apple, Microsoft, Amazon, and Meta. Do you see any upcoming catalysts to flip in the favor of value investing? And has the dominant growth stocks changed your investment style or perspective?
All right. Well, Nicole, that's a great question. So, value and growth are joined at the hip. They are two sides of the same coin. All intelligent investing is value investing. And it doesn't really matter if a company is going to grow a lot in the future, it's going to shrink a lot in the future, it's going to stay the same in the future. All three of those types of businesses can fall into the tent of value investing. All value investing is looking at the sum of future cash flows that a business is likely to deliver from now till judgment day, discounted to present value by a reasonable interest rate. And then we compare that to the price that it's being offered at. So at one price, NVIDIA could be a value investment, and another price, it could be a speculative investment. And the same applies to Microsoft, and the same applies to Berkshire Hathaway and a zillion other companies. So when Buffett invested in Apple, for example, he was not, quote unquote, buying something with low growth and value and so on. He basically looked at the future cash flows versus what he was paying for it. And the equation made sense to him. That is really the equation we are focused on, which is, like Buffett says, he says, Aesop says a bird in hand is worth two in the bush. And he says the question to ask is, how likely are there two birds in the bush, and how long is it going to take you to get those two birds when you give the one bird? And that's basically what investing is all about. So to illustrate the point a little further, the difficulties we run into in value investing, the definition of investing and value investing is painfully simple. The sum of future cash flows discounted back. The difficulty we run into is, even in the simplest of businesses, estimating those future cash flows is relatively difficult to do. And it becomes more and more difficult the further out in years that I go. Rahul gave a big disclaimer about no insider information to be disclosed, etc. But if I were to ask this audience, just a very simple question, you're insiders at Microsoft. Just tell me the next 10 years of cash flows. Give me the next 10 years of cash flow with an 80% or higher probability. And if you can do that, if you could give me those 10 years in cash flows with the 80% or higher probability, and you guys are insiders, so you guys are well positioned to give me that number. And Rahul might break out in hives if you give me that number, but that's okay. We don't care much about that. I could then discount to present value. That would be relatively a simple exercise to discount that to present value. But my suspicion is that even Satya could not give me that number, or even Bill couldn't give me that number, because they don't know, and because it's a range, and that range could be pretty wide. And so investing becomes more and more speculative and away from what we would call intelligent investing, the less we are able to have convictions and confidence in those future cash flows. So my own response to that, and everyone has a different response to that. Someone